Hello, everybody, and welcome along to this recording. Delighted to have so many of you with us for this webinar. Investment gold is, of course, a red hot talking point at the moment in the current economic and global climate, with investors and customers of the Royal Mint rushing to utilize the yellow metal to balance their portfolio. Taking the last recorded price, in fact, of 2024 into account and looking at the price on the day of this recording, or at least yesterday, the price in GBP for gold is actually up 34%, and the momentum is showing no sign of slowing down. But of course, what if it does? Well, this webinar is basically based around what does a bear case look like for gold at the moment. My name is Toby Osborne, and I'm looking after at the moment our portfolio of wealth management products at the Royal Mint for precious metals. And we've got a great presentation lined up for you today, and I'll introduce our guest to take us through it in a couple of moments time. But just ahead of that, of course, I would encourage you after the presentation today to visit theroyalmint.com and utilize some of the other pieces and articles written by our experts across the organization. There's some really insightful stuff as part of that. And of course, if you do take the decision to move into the gold investment market as well, we'd recommend you really doing your research and understanding what product across our portfolio at the Royal Mint really works for you. I'd also encourage you to follow us on X, Instagram, LinkedIn too, as we're often sharing really insightful pieces of information across there about the wider organization and all of our other divisions as well. I'm delighted to say that joining us for this today to run through a really insightful presentation is Ray Jia, research head for the World Gold Council for China. And after the presentation, we're going to run through a couple of questions as well from myself. So hopefully you'll find the information shared today really useful. So without further ado, thank you for joining us, Ray, and we'll let you take us through the presentation.
All right, thank you. And it's an honor to be here to for this presentation. So my name is Ray, and I based in Shanghai. I cover research for China, Australia, and Japan, and I also look after global gold ETFs and a couple other sections in the gold market. So today I just want to run through the recent gold market trends, and as Toby just mentioned, what's a bear case for gold? That's a report that we just published a couple weeks ago. And so I would like to start by a brief introduction of who we are. So the World Gold Council, we are a membership-based organization to develop, sustain gold demand across the globe and provide industry leadership by improving access, understanding, and trust in the gold market. And we have 31 members or gold miners, top gold miners in the world. That's the next slide. And that is us. And now let's dive into what's driving gold. So I think this was done last Friday, and I think it's already outdated as the gold price has started to refresh its record highs 2-3 more times so far this week. So we're looking at 38 or 39 new highs in the dollar terms for the LBMA gold price PM. And now we're seeing a stunning 40% increase so far in 2025 for the LBMA gold price. That's after a very impressive 2024, which refreshed its new highs 40 times. So that's an impressive performance of gold. So what's driving the gold price? At the World Gold Council here, we categorize gold drivers into 4 groups. That's the next slide. Strategic ones, economic expansion, risk and uncertainty. These link to consumer demand and investment demand. Also tactical, which are more shorter term. Opportunity cost drives gold futures traders behaviors, and also momentum coming from both gold futures traders and ETF buying. So currently we are looking at these 4 drivers, and we have a model attributing the gold price performance to each of the factors within these 4 groups. So if we go to the next slide, we can see that so far in 2025, you can see we have different groups, and each group we have different factors. For example, opportunity cost rates that includes the 10-year U.S. Treasury yield, and the same for others. So in summary, so far in 2025, we found that under risk and uncertainty, the geopolitical risk index has been a major contributor to the gold price return, and also on the opportunity cost FX, which is dominated by the weakening dollar, also contributed to the gold price. And more recently, we have seen rising momentum, especially in September. So far. So this chart shows the monthly moves, and we also have a weekly one. And so far in September, we have seen U.S. investors and Europe gold ETF investors picking up slack and buying a lot of gold ETFs, pushing up the gold price in recent weeks. And the great part I want to mention is that because this is a monthly frequency chart, so our estimate of central bank gold buying only runs each quarter. So these unexplained residuals of the gray bars here, we believe represents central bank gold actions. And now to a more broader picture of who is buying gold, who is not buying. So we're looking at the 10-year annual average, comparing with the last 4 quarters average, and we can see the change in different demand sectors and the behavior change of different gold holders. So we can see clearly that jewelry consumption has come down because of the very high gold price and because of uncertainties of the economy growth in major markets. In contrast, bar and coin investment, particularly gold ETF inflows and central bank buying, has increased noticeably comparing to their 10-year average. So, like I just mentioned from the last page, retail investors, gold ETF buyers, and central banks have been buying gold in recent years and a major supporter of the gold price. And lastly, I just want to touch on the topic of the potential for either the room for gold investment demand. So right now we're looking at near peak holdings of gold ETFs, but it is very important to note that comparing with itself's peak doesn't mean anything. We need to look at this from a more broader perspective. Does investors have enough gold in their portfolios comparing to their equities, comparing to their other risk assets? We'll go into that later. But in contrast of the near peak gold ETF holdings, COMEX investors or futures traders are still way off their peak, 43% below the peak of around 900 tons. Right now, we're looking at around only 500 tons. And the next slide, I just want to show that comparing to the overall financial market, either global stocks or U.S. stocks, it's from our point of view, there are still potential room in increasing gold holdings in investors' portfolios. We recommend around 2% to 10% of optimal allocation to go for investors to diversify their risks and improve their returns. So if you look at the relative size, the gold market still has room to grow. And that being said, now I just want to go briefly through the bear case for gold. So this comes as a request from many of our clients and institutions that we talk to. And with the gold price rallying so much in recent years, they just want to understand the risks, what happened to the gold price during its past adjustment cycles. So we looked at 5 cycles of gold adjustment since 1971. And the next slide is a summary of the cycles. You can see that they are all following a bull run, and then there's a pullback. And comparing to the size or the decline of the pullbacks, we can see that the bull runs have clearly outperformed um, the bear ones. And the drivers, it's interesting to summarize all the drivers of the pullbacks in history. And there are a lot of similar stuff in the past pullbacks. So for example, in almost all cycles, we are seeing cooling risks, rising risk appetite, or rising opportunity costs, either the dollar or the interest rates, except for just one cycle where central bank selling and rising gold supply has sort of weighted on gold from a supply and demand condition point of view. And if you look at the next slide, you will see it more clearly. So except for the one in between 1987 and 1999, which was caused by central bank gold selling and rising gold supply. You can see all other 4 cycles, they have higher, stronger dollar. They have rising real real interest rates, and these combined with rising risk appetites of global investors reflected in the rallying global equities during these periods. Gold price went through pullbacks during these periods due to these similar factors. So what's going to slow gold's recent rally, and what's going to cause an inflection point or cause a prolonged gold pullback, just like in past cycles? So we let our imagination go wild based on historical facts. So we summarized a table here in the next slide. That these are the factors we see as the scenarios that could slow gold's momentum in recent years. So as you can see here, I just want to briefly mention the 4 drivers we just talked about. And in the short to midterm, we believe gold traders, gold ETF demand, and these gold investors can move the gold price, and they're impacted mainly by many factors from the financial side. And in the longer term, gold jewelry buyers, institutional buying, such as central banks and other institutions, and also industry use, they also become price setters. So demand in the consumption space also matters in the longer term. So right now we're looking at the short term, and so you can see these are all related to factors impacting investment demand for gold. So first of all, if everything is peaceful, there's no war, there's no trade war, and all the conflicts sort of eases, and this will reduce risk and uncertainty, which is one of the key contributors to the gold price increase so far in 2025. So, or if America is great again, that means the US economy, the global economy thrives because of either AI breakthrough or other means of productivity. We don't know, but if global growth is strong, then investors' risk appetite will rise, real interest rate will rise because of stronger productivity, and safe haven demand for gold or in general will decline, weighing on gold. And the other one, I wrote this in July, so right now it's probably a 60% increase over the past 12 months. So after such a sizable gain, speculators or just investors in general without other considerations of hedges are likely to pull out to profit on their positions, and these could impact momentum. So, for example, gold ETF outflows, futures traders selling their positions, these will slow gold's rally. But if we look at the past cycles of pullbacks, it's usually it's usually two or three, or all of these combined, acting as a major force pushing gold down. So these are the factors we believe could impact gold market sentiment in the short term. And the next one is more severe. That's what we mean the longer term pullback or longer term bear run could be caused by structural shifts of demand, could be caused by competing assets booming, replacing demand for gold. And also it could be caused by a sharp rise in gold supply in the short term. So first of all, if central banks step away from gold, they become net sellers, just like in between 1987 and 1999. Then there will be, as one of the major factors supporting gold's bull run in the past 3 or 4 years. If central banks start to sell gold, then that may weigh heavily on the gold market sentiment. Or if there's a universally accepted crypto market regulation framework or improved liquidity in this space, and people trusting more in cryptocurrencies, then this part of particular demand could replace gold as safe havens or as other types of value storage, this and that. So this could replace a big chunk of gold investment demand. And if that happens, then because gold ETF inflows, bar coin investment, and institutional buying have been another pillar supporting the gold price in recent years. If that happens, then notable gold investment weakness will likely become a factor denting the gold price for a longer term weakness. And the other one is shifting tastes. That's more from the consumer demand point of view. So, for example, if young consumers, young investors in China and India, for example, under the assumption of no capital control, and there's many other investment options available to Chinese and Indian investors, then there will probably be lower appetite for gold investment. And also, if young consumers in these two countries, because we are the biggest market for gold jewelry consumption, if young consumers in these two countries lose their appetite for gold jewelry demand, then there will be a significant slowdown in gold jewelry consumption, and from this notable weakening demand is also likely, just like the gold investment weakness, is also likely to weigh heavily on the gold price. Lastly, striking gold. Interestingly, we are putting together a piece answering all the questions from the supply side, including issues like, what if there is a large deposit to be found, and could that impact the gold price? The short version of the answer is no. But let's just say if there is surging gold supplies all of a sudden in the short term, either from central bank selling or from some magical way of fast gold mining, and these gold pour into the market, is also likely to cause very severe stress for the gold price. But I have to stress that each of these scenario under the current circumstance and economical, geopolitical landscape right now, we don't think they are likely to happen anytime soon. So that's a summary of our views based on historical evidence.
Amazing. Thank you very much, Ray. That was really, really insightful, and great to sort of understand, I think, or get a clearer picture of where we are at the moment and what has been the main factors in driving the recent uptick in the gold price, and then of course a kind of a longer term view of what could happen in more of a bear market as well. If you wouldn't mind, I'd like to ask a couple of questions on behalf of those that will be watching this in the not too distant future. You obviously mentioned all of the factors at play at the moment that are impacting the gold price. Us at the Royal Mint, incidentally, over the weekend just gone, I think we've seen 17 buy transactions to every one sell, which is way above what we usually see. I think it's roughly 9 purchases to every one sale that we see through our online platform or online trading platform, which suggests that people don't feel as though the gold price has peaked as of yet. So all the factors at play, uh, US government debt, unsettled bigger economies, all the risk and uncertainty we're seeing, and conflict around the world as well. So I think this, in any case, if we were to see a cooling off in the gold prices, it's very much a long term view, not anything we're going to see sort of anytime soon.
So what was the question?
So I'm basically reiterating, I think, what you said more than anything else.
Yeah.
It's likely to be a long-term view that it doesn't feel to me as though the situation Russia-Ukraine is going to settle down any time soon. The tension in the Middle East as well, and also, we've seen months or consecutive months of central bank buying in certain bigger economies, like for instance China. So it doesn't feel as though the momentum from that is going to slow down anytime soon.
Yeah, based on current evidence, you're right. The central banks are buying their conse nonstop, and we are seeing increasing gold ETF inflows into North American gold ETFs, into European gold ETFs, and now we're seeing positive flows to Asian gold ETFs in China and India. So obviously, people are still buying gold ETFs. And during our last week's report, we believe this may be centered around, first of all, the Fed cutting cycle begun again, and so the expectation of lower interest rates ahead is obviously very important, and also stagflationary concerns of major economy, for example, in the UK or in the US, um, are concerning people. And our reports past analysis shows that gold does perform the best comparing to other assets during stagflation-like conditions. So I think that's driving people to gold.
Yeah, absolutely. And it's going slightly sort of off topic in some respects. Obviously, AI at the moment is a hot topic, and you mentioned it as part of the sort of presentation in terms of enhancements on that. Of course, over the years we've seen um, people utilizing the ability to utilizing technology to place trades on precious metals when it hits a certain point and do that automatically. Do you see AI having, broadly speaking, a major impact on the precious metals market, or will it sort of simply be a case of maybe AI making it more accessible to a wider group of people and people being able to actually make more informed decisions when it comes to precious metals investing?
Oh, yes, absolutely. I'm not an expert in AI, but I do use AI. I use DeepSeek all the time, and a lot of times I ask DeepSeek something about gold. I get my own results back. I think it's a good thing that that's all we want to do. We provide first-hand primary research data to the market, and the AI is consolidating all of the clues. And when an investor asks DeepSeek or ChatGPT, then they output such useful information for investors. I think it's making the decision more effective and it's making investment itself, like you said, the trading more effective and seamless, to be honest. And also, I think in other areas such as jewelry design, we are seeing a lot of AI uh, adoptions in that space, and also in I would imagine in the gold mining space, it's helping the whole industry to shape, to make more informed or effective decisions.
Absolutely, possibilities seem endless. In terms of, we're very used to having a view on the gold market in Europe and in the US, and then in the UK, of course, there's certain tax implications to buying gold in various forms, whether it's buying gold coins here because of their CGT-free status. What sorts of patterns do we, and how does that compare to consumers in China? In what sort of form typically are people looking to buy gold? Is it through jewelry predominantly, or is it still very much the bullion market?
It's a very interesting question, and we have been observing the gold market in China in every year, every month, and from 2019 when the gold price was okay, and sort of the risk hedging or store of value or uh, savings sort of thing was not big here in China. People still treating gold jewelry as jewelry, and of course, there's a sense of store of value there, from ancient times, and people, if you want to invest, you will go to either a jewelry shop or a commercial bank to buy gold bars. And some of us love panda coins, so we also go to commercial banks to buy their different versions of panda coins. And right now we're seeing a big part of the reason that gold jewelry consumption is still there. It's still not, well, it's declining, but it's not declining as sharply as we would expect it. It is because that a big driver of gold jewelry buying is also investment. So people are looking for items with low labor charge. They can be an accessory for them for the daily wear, and it can be an investment. But since last year, we have been seeing very strong bullion buying from commercial banks, from jewelry shops, and also gold accumulation plan. Where people can invest in gold periodically, automatically through their bank account, also through commercial banks. And I do want to raise one point that gold ETFs. It used to be a small part of China's gold market. We have around 900 tons to 1,000 tons on average every year for gold demand, and gold ETFs have been around 50 tons for 30 to 50 tons for most of the years. But from last year and this year, actually at the start of this year, gold ETF holdings in China was around 80 tons, and now it's 180 tons. So you can see there's an explosive growth in that space, and I think people are using online channels to buy gold more, but still, there's still the strongest part section of gold demand in China is still gold bars buying through commercial banks and through gold jewelry shops.
And do you think maybe that, in terms of, I guess, communication to the wider Chinese population, do you think that maybe stems from the consistency at which the central bank has been buying over a period of time? I mean, do you sort of see that slowing down at any time? I think, and you'll correct me here, but as I understand, I think in 2024, China, it was the biggest year on record in terms of tonnage of gold purchased by a central bank. I might be wrong on that, but I think that is the case. Do you think that has kind of, I guess, maybe been communicated almost to the wider Chinese population, and that has improved the sort of popularity of it as an investment option?
Yes, absolutely. So, whatever the central bank does here in China, people look to the central bank and will be like, okay, so the PBOC is doing it, and we must follow because they have their reasons, and that's very obvious here in China, and we have identified this as one of the major drivers of gold bullion of bullion investment in China in the past years and this year also. And the other key factor driving bullion investment is that it's simply the best performing asset in China, and it's the only non-renminbi asset that you can invest in China without limitation. And also other, where do Chinese people park their money at? Typically either bank savings or properties or gold. And you can see here right now we are looking at a rate cutting cycle. We started the cutting cycle earlier than the Fed, and everyone is expecting the rate to go down, and it will go down according to all sorts of policy guidance, and whatever, because we need to support the economy. So the rates are going down. So it's not sensible to put your money to at banks to earn that very small interest. And then property, and as you might be, hearing, so the property market in China is still recovering, or is still bottoming. It's still finding the bottom. So that's not the other ideal option is gone. So the only option you have right now is gold. And gold has performed much better than equities, than bonds, than any other investment option you can find in China in 2023, in 2024, and now in 2025. So after its proven records of beating other assets and saving your money, storing your value, investors are just looking to go as the
Yeah, and just finally, just because it was something I found quite interesting, being a millennial myself. So for those, I guess, don't know the bracket in which you sit, in which millennials are 30, the age of 30 up to 45, and then and Gen Z as well. They actually make up a bigger portion of our customer base at the Royal Mint than they do as of the wider population in the UK, which is interesting given I guess they've come through the financial crisis of the late noughties, COVID more recently as well, and are living in a time of such geopolitical uncertainty too. Is that a similar sort of, given that they're very pro gold in the United Kingdom, is that a similar sort of trend you may be seeing in China as well?
yes, very much so. Especially given how their or even younger generations awareness of financial management, because we're a ancient country, but at the same time we're a young country, coming from coming from the poverty years, and we're not that many years into the wealth state,
Mm,
and our dads, that their generation, their sense of financial management is very low. And now, as the country grows stronger, we're getting wealthier, and the young generation, their awareness of financial management is very strong. They start to invest in their universities, some even from high schools, using their parents' accounts. So this sense of financial management naturally guide their attention to gold, which performed much better than other assets, and they do understand the all the case for gold. We right, and now they're buying gold because they want to store their money, and they're buying gold jewelry as investment and as accessory for their daily wear. And so I would say yes, the young generation, the young investors are in China are very much pro gold, just like the UK.
it's very interesting. Look, we could ask you plenty more questions, Ray, but that's pretty much time for this webinar. So thank you very much for your involvement today. It's been really interesting, and I'm sure those watching have really benefited from it as well.
It's my honor. Thank you.
Thank you very much. That's Ray Jia, then from the World Gold Council, research head. And of course, if you do want further information on the precious metals market, namely gold, then you can head to the World Gold Council as well to find out more. There's plenty of articles and insightful publications on there for you to really educate yourself ahead of making a proposed, I should say, investment. I'd also encourage you to head to the Royal Mint website as well, and our market news segment too, because there's lots of information from our insights team on there for you to read through. You can follow us, of course, on social media as well, through X to Instagram, and find out about the wider organization, whether that's our collecting coin department, our 886 jewelry line as well. Everything comes back to the world of precious metals with the Royal Mint. So I'd encourage you to have a look and find out more. And of course, you can utilize our account management team as well, who are on hand to help guide you through the investment process as well. That is it for today. So thank you so much for joining us once again, and we'll see you next time.